In financial planning, oftentimes when it comes to investments, they always talk about diversifying what you own, but they fail to talk about diversifying where you own it. What I'm talking about are three types of accounts: Roth accounts, traditional accounts, and taxable accounts. In Roth accounts, you contribute after tax, but every bit of growth and every withdrawal later is tax free. Think of this as a hedge against future tax hikes. In traditional accounts, you can get deductions today, which lowers your taxable income, but every dollar you pull out later is taxed as ordinary income. So it's best if you expect to be in a lower tax bracket when you retire. And even if your contribution isn't deductible, that's okay. The tax deferred growth still compounds faster than taxable accounts. But just track your basis on IRS Form 8606 so you don't get taxed twice on the same dollar. Taxable accounts, you pay taxes on gains, but you can access the money anytime. That flexibility gives you options, and you can harvest gains or losses strategically and control your cash flow year to year. The key to all this is that the real diversification isn't just across asset classes such as stocks and bonds, it's across the account types. That's what gives you control when it's time to take withdrawals. So I would think about it in phases. In your 20s and 30s, lean into Roth contributions, pay tax now while your rates are low. In your 40s and 50s, blend Roth and traditional to balance growth with tax relief. And in your 60s and beyond, use the mix: Roth, traditional, and taxable to manage your RMDs, Social Security taxes, and even Medicare surcharges. So if you were to ask me what I'm doing, I'm playing both sides of the fence. I'm using Roth accounts, particularly within a Roth 401k because there's no income limits there. But I'm also maxing out my traditional IRA and getting that tax deferred growth. And then anything else I'm flowing into that taxable brokerage account, utilizing not index funds like all of the influencers suggest to do, but using a rules-based active management approach within my account. The way we see it, having account diversification is incredibly important, just as important as asset class diversification. It allows flexibility, it allows for further financial planning, and as you approach the traditional retirement age, or what we like to call work optional, it's going to allow for more flexibility during those conversations.